Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we're on the line with Kevin Kelly, Chief Investment Officer of Recon Capital. Happy St. Patrick's Day.
Happy St. Patrick's Day. I'm excited to be here, guys.
All right, let's get things started out here. And a lot of macro themes going on that are affecting the market or in the press. And let's interpret some of them. This one is already gone through. Draghi in the ECB quantitative easing. What kind of effect is that going to have on the U.S. economy and the U.S. stock market?
Yeah, so if we take a look at how the markets reacted all year, I mean, the S&P 500 has closed up 25 times on the year, but down 27 instances because there are these macro themes that are playing through the markets, and it's really affecting company earnings, right? So we saw that last quarter when companies reported, and there's going to be really big uncertainty going forward for Q3, Q4. So analysts have really been concerned about oil and its effect on basically the job sectors. Because if you look at the energy sector, it was a reliable job creator and source of earnings growth over the last 5 years, and now that's gone. Now you've got ECB quantitative easing coming in, so you've got big multinational companies having the strength of the dollar going against them. So how is that now going to play into earnings? So if we look at yesterday, it was pretty interesting. The market rallied, but if you went into the options market, if you looked at SPX index options traded, you saw 1.6 times the amount of puts being traded versus calls. So that shows you everybody's hedging out. You guys touched base on it a little bit earlier that profit takers were coming in. So with the new strong dollar as well as the weaker euro, it's really going to have an impact later this year on companies because analysts don't know how to factor that into their earnings models, as well as companies don't hedge revenue growth. I mean, they don't know how to hedge revenue growth. They can hedge the earnings that they're incurring, but they don't know how to effectively hedge out the growth that they're expecting. So ECB quantitative easing is another macro theme that's just going to be affecting the market for the upcoming quarters.
Okay, strong rise in the dollar as of late. Could that be anticipation of higher interest rates by the Fed? Maybe they'll raise tomorrow.
Yeah, it's pretty interesting. People are focusing on one word, and the word is patient. So that's kind of sweet irony because the market is never patient. Which is a good point because the dollar against the euro was really weak. If you go back to July of 2014, the euro was at $1.37, and now it's already moved down. And here's what's going to happen. You're going to see the Fed really see the effects of that trickle in because using their 5.5% unemployment rate and 2.2% GDP growth of the recent prints we have, they have to remove the patient number. They're already getting their dual mandate met. But that doesn't necessarily mean that they're going to make rates rise going out, past that percent or something along those lines. So yeah, maybe August, maybe September, they'll raise rates, but they're not going to know how multinational corporations are really going to continue to hire as well as affect their earnings. So it's going to flow into the economy and really affect our numbers. I mean, this Fed stimulus has really pushed the numbers to be good, but that's not going to happen going forward, especially because the euro has moved so fast, and we don't know how that's going to play in the economy. So they're going to be really, really nervous. So I wouldn't anticipate rates to rise significantly over the next year. I mean, they'll remove the patient number, they'll raise rates, but they're not going to raise them too high, and they're going to be very diligent. I mean, they may actually, as Nick said earlier, implement another quantitative easing program.
Wow. Okay, a lot of implications there for what you just said. Price of oil. I mean, we did our oil show last week. We pretty much had a consensus that oil was going lower. It consolidated at the $50 level, another leg down. Do you have any? Do you have any price targets down here, or what's going to turn around the oil market?
It's really hard to find a price target because what's happened in the price of oil is all of the geopolitical risk has been pulled out. So this shale revolution has really mitigated that, and that's been removed from the price of oil. I mean, you can see it's taking its toll on the Russian economy as well as in the Middle East. So that's great for us, and it's actually great for small caps as well because it's putting more dollars in the American consumer's pocket. I think what could happen is that you'll see a stabilization where we are right now between $40 and $50 because it's a lever. It's like, okay, turn on the spigot or turn off the spigot. What is our cost of oil? And there's so much of it out there, and people are trying to store it and sell it out going into the future. So we're going to have this overhang for a while. I mean, we're going to need a big catalyst to change what's happening in the oil markets right now, and it's really hard to see that going out because the storage story has already been played out. They said there's no more storage, yet we're still going down. So it's going to be pretty interesting to see what that catalyst will be, but we'll probably be in this range of 40 to 50 for a long time.
Okay, looking for a little support there at the $40 level. That's interesting. It just the overall effect of the strong dollar and oil on the consumer. A little bit more money in their pocket. Maybe doing some more traveling to Europe. I know my wife is trying to push me over there. More money in the pocket. A little more money to spend. Is that going to be good for the economy?
Yeah, that can be great for the economy, and I think there's another factor that people need to start looking at too. Is that people are getting more money in their pockets, and I think they're starting to see some savings come out. I mean, there's been some surveys out there that consumers are actually starting to save a little bit more. And one way to look at it as well is they're actually going to start putting more money back into their own homes as well as doing improvements, because one of the reasons why this hasn't felt like a great equity rally is because wage inflation hasn't happened, right? So all these companies' earnings are doing well, unemployment's low, but where has the wage growth been? There hasn't been one. So the only way consumers have been really getting extra income has been from the drop in oil, and they don't know how long that's going to persist. So they're starting to save some of that money and put that money back to work for them in their own homes. So that's another way that the effect of lower oil is really playing on the consumer. So they are still starting to spend. We are a consumer-driven economy, but they're also putting it in the savings.
Kevin, I'd love to switch gears and talk to you about some specific names that are moving around in the pre-market right now. A couple of tech ones on our radar. How's Alibaba looking to you?
Alibaba is a pretty interesting story, right? And it's because they have a great model and they've got a lock on the market in the fastest growing economy in the world, China. But what's interesting is a lot of people have talked about this is the lockup, right? And that's going to make a lot of people really nervous, and that's a big overhang when you start to look at the stock, because everybody knows about it. It's well telegraphed, but there is a lot of shares that are going to come to the market. And the people that own those shares own them at a lower price point than where the market's at now. A lot of people were trading Alibaba before they went public. They were buying it in the secondary market, and they were locked up. So they own it at 60 or they own it at 45. And they're going to want some liquidity. So no one's saying they're going to dump it all. But there is going to be that initial pressure to sell at least a portion of the position. So until we start seeing how it's going to shake out with the lockup, because those people do want to monetize some of their money, it's going to be really hard to see what's going to happen with the stock. And they are so diversified, and they're such a big behemoth company that we're going to want to see another earnings cycle come through and see how they're actually performing.
What's kind of your just long and short term outlook is more just going to rely on how that lockout kind of turns up, is what you're saying?
Yeah, so I think the first initial pressure is going to be the lockup. I think the second initial pressure is actually their sales. There was a little bit of a miss their last earnings cycle. Everybody was expecting Singles Day to really lead to additional sales, and actually it only pulled sales forward. So we're going to want to see how those revenues actually are performing X that Singles Appreciation Day that they had on 11/11. So we're going to have to really take a fine-tooth comb and see where, what the returns were, because there were some returns on single sales, and that's how we knew people were pulling sales forward, is because they were just buying and then seeing, okay, do we want this? No, and then they would return it. So that's going to be a big thing, is just seeing where the revenues are coming at given their guidance.
Okay, let's move on to the big dog, Apple Computer. We got it traded up 79 cents in the pre-market. Had a nice run. Kind of the end of the run ended, kind of coincided with the revelation of the iWatch. Are you going to be buying one of those?
I will not be buying one of those. It's because I like to see how things work, right? So I didn't get the first iPhone. Technology moves so fast that 2 years down the road, I'll definitely be interested. And once they start working out how it actually integrates with the phone and whatever other devices, but I'm gonna hold off on getting the initial iWatch.
Are you a level guy, like in something like Apple? Are you keeping an eye on the all-time high, 133, or the all-time high close? I believe, the all-time high is 33.10, I believe. All-time high close 33. You have some support at the 122 level. Are you a level guy? What are you looking at?
Yeah, so we are looking at certain levels, especially at that 133 level. But what we're really focused on is, we think actions speak louder than words. And Apple went overseas and they went in the Swiss markets and they raised a bunch of money in the debt markets. Why? So they've got to return. So their dividend is low now, given the rise, and that's why we're looking at the 133 level. They have about $30 in cash. They can implement more buybacks. So we think the next catalyst and the big push. So we think the low is in. The low is in right now. We think around this 124, 120 level. It's very stable, and we actually can see that what you can do is you can turn Apple into sort of an I bond, right? You can sell the 120 put and collect in all that premium and generate about 8 to 10% for the year, given that they do have that $30 in cash. So we don't think there's much upside. Where they'll take us above that 133 level is that when you start getting them saying, hey, we're going to implement a higher dividend, we're going to increase it, we're going to increase our share buyback, and actually start putting a lot of this capital to work. So we think that's kind of what's going to be happening with Apple in the next quarter and the quarter after that.
Did you patent that iBond?
No, I did not patent the iBond, but I'll start looking into it. Maybe I'll partner up with Nick, and we'll start coming up with maybe some put spreads, selling those put spreads to do an iBond.
So we've talked about it, but you're looking for the next catalyst for Apple, being you went into the debt market, borrowed the money. They need to return it to the shareholders. So you're looking for more buyback and a dividend increase and make it even more of a value stock. Very interesting take on that, especially the iBond there. Kevin, one of our traders wants to know what you think of PVH and that industry in general.
PVH, so is that Phillips Van Heusen?
Yes, it is, and it's been coming down kind of hard lately. You hit the 110 level. Boy, you could draw a trend line coming down. I think it's quite a bit off its all-time highs. Yeah, not too far. So what do you think of this stock in particular and the sector in general?
So that's a pretty interesting name to look at, and sector, because they are the ones that are getting impacted by the stronger dollar as well, especially in their international operations. So you're seeing that happen with Ralph Lauren, and you're also seeing that their input costs are staying around the same. I mean, they're relying on cotton. So one of the things that is going to be telling is the discretionary sector over the next couple months. So we think it's kind of stable here. going forward, though, with the price of oil, if it does run up, it could really impact these stocks. And these companies actually need to find that incremental growth, but it's so cut rate. So if you start looking into some of the other retailers, even if you go into the teen space, you're seeing it is so hard, and getting that growth is really de minimis. I mean, you're seeing even Macy's, their own private label brand isn't growing, and they're discounting more. So the discounts are coming and coming and coming because people are trying to get that incremental growth, and it's coming at a big cost. So that's why you're seeing names like PVH come down, and the consumer discretionary sector. There's going to be more cutthroat competition happening.
Yeah, I've never had a big chunk of really any of my portfolio in the retailers, and I don't think I'm going to start now, especially with the increasing dollar. Let's go. Do you follow the biotech sector at all? Haven't talked
Yes.
about it. Okay, let's go to the IBB, and then we'll touch on some individual issues.
Yeah, so the biotech sector is actually a little misunderstood, especially by Janet Yellen, who apparently is a biotech analyst. If you remember one of her meetings, she had mentioned she had seen some thoughts. But what's interesting about that sector that people don't really think about is that it's sort of interest rate and duration insensitive, right? So in a rising rate environment, they're not really impacted, especially because their sales are very stable, as well as the aging population of the U.S., and especially the way our healthcare system works. So looking into the biotech sector, people talk about it being on a run, but when you start looking at individual names, you can see they're trading at low multiples, and you're getting guidance that is pretty great coming from the company. So I can touch base on a couple of the names. If you just look at Celgene.
Okay, go ahead.
Going out. Yeah. If you look at Celgene going out to 2020, they think sales are gonna double by then, and they actually did an under-promise, over-deliver mantra about it. They said 15% is going to come from their core drugs right now, and another 3% from drugs in the pipeline. Well, their drugs are growing at over 20%, and they actually have this interesting model where it's sort of a VC model. They will take 20%. Or 10% or 15% of smaller drug companies and invest in them. So they've got a VC model, and as they start going through phase 1, phase 2, start hitting milestones. So they've got this interesting portfolio that is more of a VC PE portfolio of companies, and they help lend credibility to those companies and give them resources. So that's going to help them grow going into the future. And then you look at names like Gilead, right? Gilead is a perfect example of what's happening in the biotech space, where they are implementing a dividend, right? So their dividend's around 1.66%. They're still growing. They're in the top 10 of the NASDAQ 100. They're trading at an 11 PE. So there's a lot of great names, and you got to start going towards the top in the biotech. You want to really be careful and get into those names that do have stable businesses that can ride out any short-term, volatility in the marketplace.
Kevin, we're coming to the end of the segment, but I got two quick questions here, 15 seconds each on BRCX. That's the first one. Just a quick technical look on that one.
BRCX. Yep, let me pull it up right now. I mean, we've hold on, sorry. It's
that's okay. My computer's slow too.
What was the other name, too, in case I've got here? I can pull that up as well.
Jazz, Jazz.
Oh, Jazz. Oh, yeah.
Let's do that one.
So Jazz is a great. I think if you start looking at Jazz and the technicals, I think it's pretty stable here. I don't see a big breakout. Looking at this chart, I mean, I think you can't have an entry. Basically, in the biotech sector right now, we're seeing some short-term headwinds coming up with earnings coming up on the overall market. So a lot of these charts have run up, and we would be cautious entering into new positions. But we think there's some ample opportunities to sell calls or even buy some sell some put spreads on some of these names.
Kevin, I don't know where the time went, but it's been very informative. Kevin Kelly, Chief Investment Officer of Recon Capital. Thanks, Kevin. We'd like to have you back on again soon.
Thanks so much, Kevin.
Have a great day, Patty.